Welcome to the Mortgage Broker Podcast, tailor-made for Canadian mortgage industry professionals. Proudly presented by A Better Way Mortgage Group, this podcast is your trusted source for insider insights, market updates, and strategies to elevate your career in the ever-evolving world of mortgage brokering. Whether you're a seasoned broker with A Better Way Mortgage Group or an industry enthusiast looking to stay ahead, our episodes are designed to empower you with the knowledge and tools you need to excel in the Canadian mortgage space.
Okay, we are back for another episode of the Mortgage Broker Podcast, and today we have a special guest joining us for a Behind the Lender episode. Welcome Taylor Little, CEO of Neighbourhood Holdings. Taylor joins us today to provide some history and real-time insight into the machine that is Neighbourhood Holdings, as well as the recent acquisition of Fisgard Asset Management. We're also joined by my business partner, Jason Marshall, here as co-host. So Taylor, thank you very much for joining us this morning, and welcome to the show.
Hey, thanks for having me. Excited.
Absolutely. I do want to point out before we get started that Neighbourhood Holdings is a preferred partner of our brokerage, A Better Way Mortgage Group. You guys have been a phenomenal partner to us and our agents. Volume's definitely picking up, and we appreciate the partnership very much so.
Yeah, and likewise. Yeah, it's been great. And one thing that we love doing is building partnerships, because maybe we'll get into it a bit later, but just building those relationships with your lender makes life a lot easier as a broker.
Absolutely. And I mean, you look at the constant change in our industry. It's nice to have consistency in your business and your communication and your relationships, right? I mean, it's extremely important right now and certainly going forward. So I guess to get started, I want to get into kind of your personal path. We want to hear a little bit more about who is Taylor Little, as well as kind of the origin and creation of Neighbourhood Holdings. So maybe if you want to start off and give us a bit of a background on yourself and your path into the industry and path to CEO of Neighbourhood Holdings.
I mean, gee, where do we start? Born in Edmonton. So that I think does shape me a little bit. I've got a little bit of that Alberta in me. Most of my family is still out there, but I moved to BC when I was 18, and I did it because I was chasing a bit of a bike racing dream. And if you look on a map or if you check weather reports, Victoria is the nicest place in Canada weather-wise. But I always like to say with weather in Canada, no one's really winning. Like no place is perfect, but Victoria is probably as close to it as it can be. So I moved out at 18, went to UVic, literally fell in love. So met my wife at UVic, ended up staying in BC. So I've now been here for 20 plus years. I did leave for school twice, but BC's been my home more or less since I was 18. So one thing I did do is I moved back to Edmonton. I did a master's degree in London, England after my undergrad. Decided I was a bit lonely and homesick because, moved at such a young age. Didn't really expect to stay out here forever. Brought my then girlfriend, now wife, with me and said, Edmonton's great. Let's make this work. Went to law school, got a job, thought we were set up. And then she said, I don't want to live here. I grew up in Kelowna. We went to UVic together. BC's the best. I'm like, you're not wrong. I said, so I'll tell you what, we've got a good gig here. Why don't I apply to a few really great firms in BC? And if I get a job, we'll move. So I did that, got a job, kept the job, and practiced law at a law firm called Stikeman, Elliott for about 4 to 5 years. And during that time, because, I was new professionally, I didn't have a professional network in Vancouver. I basically did everything I could to meet people. So you guys probably experience this too. You buy a table for a fundraiser or a gala or whatever, and you got to fill the seats. I was the guy. I'm like, you need a guy to eat a rubber chicken? I'm there. Every cocktail, every dinner, I'd go. Consequently, just met a lot of people. Also met a lot of people through biking. And funny enough, that's kind of how I met Alex Conconi. We were at a house party. We got chatting. Turns out Alex likes bike riding. I said, well, let's go bike riding. He needed some legal advice because he was building LENDER at the time and writing his own contracts. I said, you should probably have like a real lawyer look at that. So I was also fishing for a bit of business, and Alex and I developed a friendship, and he became a client. After a few years, he said, hey, I'm thinking of getting some stuff going on the family office side. Do you want to join? So what am I joining? He goes, I don't really know, but it's a thing. We're going to build some stuff together. And I said, sure. One maybe background piece to this is I grew up in a legal family. So my dad was a lawyer. He's now a judge. I've kind of seen the legal movie. It's a great life. If you stick around, you make partner, you're going to live a really great life. But having seen that movie, I thought, you know what? Why don't I just try something different? So I loved my practice. I'm not one of these guys who left a big law firm because I hated it or was burnt out. I actually really enjoyed my time, spent a bunch of time in Toronto as well with the firm. But I thought it was kind of exciting to look behind door number two. So when we were canvassing what the family was doing, one of the things the family was doing was a lot of private lending. And the family had built a little bit of a business around it. So Jared Stanley, who a lot of people know here, who used to be Alex Conconi's boss, was brought in to help build a bit of a broker network and get some submissions going because the family liked investing in mortgages. Alex's dad was an entrepreneur and had a really successful exit and had a bunch of capital to manage. And one of the things he liked doing was lending. So, prior to the great financial crisis in '08, the family was doing a lot of high risk lending, frankly. So a lot of bare land. There was a motel in Squamish, there was farms, there was all sorts of random stuff at really great rates. Your real private lender stuff. A lot of that didn't really make it through '08. So there's a lot of foreclosure, a lot of workouts. Alex has all kinds of stories about going to a house outside of Edmonton and there's a horse in it kind of thing, or people putting concrete down toilets, like real rowdy, rough stuff. So the thing we did is we thought, we don't need that. Why don't we just look for really great deals, sleep at night stuff, and we can just sit on it and earn a fair rate. So that's kind of how things got going with neighborhoods. So the family eventually allocated a good chunk of money to that space because we were providing great service, we were providing great rates, and a lot of brokers would come back to us. And as you guys would know, if you can't fund a deal, you're probably not going to call that lender anymore.
Yeah.
So what we did is we thought, hey, if we want to keep doing this, we got to spin it out. So in 2015, we spun it out. We spun out the activity. We invited a few close friends and family to invest with us, called it Neighborhood. We wanted to be kind of generic. So just behind the scenes, we were a few brokers' favorite secret. So just this generic title, no marketing really. And if you're a Seinfeld fan, my usual joke is yada, yada, yada. Here we are today. We're kind of just doing the same thing, except we're over 800 million from, we started, I think, rolling over about 15 or 20.
Wow.
So it's been a fun journey. And I don't come to this with sort of any prior mortgage background, although it's been more than a decade. So maybe I've earned it at this stage. But really, it was just a function of we're building a business. And one thing I've learned in my career, and I sit on a few boards as well, is most businesses, when you just really pull back, are kind of the same.
Yeah.
You've got finance, you've got ops, you've got HR. It's just sort of the same set of problems. What you're doing underneath the business, that's your specific vertical, but operating is operating. So yeah, in 2018, I became the CEO of Neighbourhood, and it's been really fun ever since. So I think it suits my disposition, frankly, as a lawyer, a former lawyer. I can barely call myself that. I guess I'm still technically one, but we're diligent, relatively conservative, but business forward. It was the right business for a guy like me to operate. It's not like a super high growth, bet the farm on some genius plan. It's just being really consistent and diligent and compounding over time. And I think that's going to be the path for the next kind of 10 years here.
Did you ever, when you were looking at door number two, going from the legal side into the lending side, was that like a lot of convincing to yourself and your family, or was it an easy decision? And when you made that transition, where you're like, oh shit, like I wish I stayed on the lawyer side, like did you have any of those kind of moments?
A couple thoughts. One, it was right around the time my dad was leaving to become a judge. So funny enough, when him and I first talked about that, we were canoeing in the Yukon. We did a thing called the Yukon River Quest, which my dad's obsessed with. And at the time, at least, maybe not anymore, it was the world's longest canoe and kayak race. It's pretty funny and crazy. It's not physically hard, it's just mentally hard. But we were paddling, and my dad's been one of the most consistent people in my life. He was practicing law for 25 years, and he, I think at the time, was 53. And he goes, I'm thinking about the next 20 to 25 years of my career. And I kind of looked at him like, the next 20 to 25? I mean, what are you talking about? He goes, yeah, I don't know if I want to keep doing the same thing anymore. What happens to a lot of lawyers, they tend to fade, so you're spending more time down in Palm Springs or Phoenix or wherever it is. And, eventually some younger, hungrier person takes your clients, and the new partners are going, why is this guy still on the payroll? And you're kind of gently pushed in. I don't think that would have happened to my dad, but that's a different story. And he goes, so I think I want to apply to be a judge. So, well, that's super cool. Why don't you do it? And it happened relatively quickly. So I think the fact that that happened around the time that I was looking at this too, it was just like, hey, why don't I do the same thing? It's kind of fun. So it took not much convincing from my dad. And then I had really good mentors at Stikeman. So one of my main mentors there, Nordin Angie, who's phenomenal. He actually exited a partnership when he was a lawyer to go into industry. I think he left for about 10 years, then came back to Stikeman as a partner. And I talked to him. He's like, you should do it. Like, you're doing great here, but we'll take you back. Like, if you leave for a year or two, it'd be great. We'll call it like a rotation or something. But
I spot for half.
yeah, so there was no risk really, or very little risk. So no, I didn't have any moment. I think the thing that really was tough for the first 5 or more years was a little bit of imposter syndrome. Like, I don't have a finance background. I don't have a business background.
Right.
You feel uncertain. But what I've learned from that too is kind of every leader feels that way.
Totally.
There's no manual to this, right? Like, if I did a Harvard MBA, I think I'd be in the exact same spot.
Yeah.
I think it took a while to shed that a little bit, where you have this piece where you're like, I'm just a lawyer. I don't understand. But again, this is not it's not a difficult business. It's lending. You put your money out, you hope it comes back more or less for what you thought you were going to get. And one thing that you carry forward from, I think, a legal practice is being really client centric, being good to work with. So those are principles I took in. Like, if you think about those principles, they all apply in business, even managing the team. I've experienced some really, really great managers or bosses and some really terrible ones. And what I took with me into a leadership role here is, who do I want to model myself after? What are the things I liked doing? Like, who got the best out of me? Here are the people who got the best out of me. And those are the people who usually let me, you know, take some rep and sink,
Yeah.
Make some mistakes. The people I hated working for were like micromanaging and difficult and stressful. And so I'm like, well, I don't want to do that. And so I think one thing we've imported into the culture of neighborhood is there's a real, almost entrepreneurial style in this business where it's like, I don't care when you show up. I don't care how you do your work, but you just have to work really well with your team, work really well with our brokers or investors or bankers or whoever you're interacting with. And I leave it to you to do it in the way that you think is best and most persuasive. And that works for some. Certainly it works for our team here. It doesn't work for others. Some people are like, hey, I just need to paint by numbers and tell me what to do. So of course we have guardrails in our business. It's not a cowboy operation where people can do anything they want. But in terms of kind of your work-life balance or how people work here, I think my experience as a lawyer, helped with that leadership style. So
Definitely. I mean, you created a very unique and strong culture with that kind of a mindset within the office. I think the only challenge that can come with that is, do you have the right people that are going to be able to manage? But at the end of the day, they're almost self-reporting, right? Because you can manage expectations and see, what they're achieving or not achieving. But I want to go back to one thing before we dig into neighborhood a little bit more. You talked about the Conconi family, and when they were originally doing some private lending, they were doing some high risk, high return lending, some, very high risk deals. Neighborhood is not that. From my experience in the last 10 years, it has not been that. It's quite a drastic shift into the model that you run today. What was the concept and the thought when you launched? And like, you've always been a very well-priced lender, a very conservative lender, which comes with a lot of positives. So yeah, I'm curious to hear your thoughts.
it really just comes down to experience. And coming out of 08, 09, 2010, even longer than that, when a lot of these deals are returning zero or less, where you're losing principal, you realize, was it worth it? Was it worth doing that illiquid, difficult deal? When I first came over, I helped with this one. It had 9 mortgages on it. There was some fraud on this file. So over years, we had to work with lawyers in the court to wipe off all these other charges that were fraudulently put on title. And you're like, what a pain. So really, if this were an investor pitch, one thing that we kind of led with was, hey, we're already rich. The family's doing well. There's no reason to reach for
Right.
really, really high yield. We just want to sleep at night. Let's just lend in the liquid part of the market, which is houses, townhouses, and condos. Let's do it at low LTVs, at rates that are going to encourage brokers to submit to us, and we'll just get paid and leave it be. And we can be patient. We don't need to shoot the lights out. It's kind of not much different than how you want to approach an equities portfolio, right? Like, probably most of the listeners here own some stocks, and you can choose to take the high torque risky stuff, or you can choose to put your money into an index and just ride the market. And I think for us, really the lessons out of that are what inform this business. And that's certainly what resonates with our investors is our approach to the market. Now, that's neighborhood. Fisgard's a little bit different. And this was actually something that I was very dogmatic about at Neighborhood is we've not changed our credit box to our own detriment. We could have grown a lot faster. We would be much bigger today if we took more risk. But that's not the product we've sold our investors. We've said, look, this is what we do. This is where we hit the market. This is why we do it. This is the story that resonates with investors. The nuance with Neighborhood is we were always comfortable carrying a little bit of leverage on the portfolio. So the way we could deliver a reasonable rate of return to our investors by lending at this kind of first position, low LTV, low rate is enhancing returns with a bit of leverage. So our stance on that was we'll take less risk on the asset and we'll manage the financial risk of leverage. So we'll manage liquidity, we'll manage our bank syndicate, all that kind of stuff. And we're good at it. Fisgard had a bit of a different approach. Fisgard's like, we don't really like using a lot of leverage, but we'll take a bit more risk on the asset. We can be a bit more common sense. We will take a bare land deal at Fisgard, or we will take a multifamily or a construction or whatever it might be. It just has to make sense. So part of the reason why we did that deal was how do we, especially in a down market where equity has shrunk, right? So in a rising market, it's easy. Everybody's got, if you're refinancing your home, it's just worth more than it was last year. So you've got room to get a new mortgage. In this kind of market, and you guys are probably seeing it too, everybody's fighting over smaller volumes. And what Fisgard gave us was a different credit box. So that's what allowed us to go to 75% LTV, for example. That's what allowed us to market to brokers and say, hey, yeah, if you've got a little construction project or if you've got a bare land deal, we can do it now. So the group you know and love, Neighborhood, and probably the other group you know and love, Fisgard, we can do your deal. And that's really opened up our ability to do more in the broker world. So that was maybe a long way of answering your question. We learned the lessons from '08, and Fisgard has maybe a slightly stronger risk appetite, but still very similar philosophy. So there's no 14% type residential mortgages in Fisgard. It's just, yeah, we'll do 75. It's a bit of a higher rate. We'll do bare land. It's a bit of a different rate. But at the same day, we all want to get repaid. And some of those other deals are just risky. You guys have seen it in the commercial world right now. I mean, a lot of those bigger funds are challenged. We're not seeing that same challenge in either Fisgard or the Neighborhood Fund.
Yeah, no, really cool. And it's insightful to hear that your lending box has opened up a fair bit with the Fisgard acquisition, which we'll dig into shortly here. I want to just touch on Neighborhood as we get going here. So we talk about this a lot lately, but there's a huge contingent in our industry of mortgage brokers that built their business on prime. Prime is becoming increasingly challenging as time goes on. We're seeing more brokers invest more time and resources into the alt and private space. So for the brokers that maybe are just kind of starting to dabble into the private or alternative space, or someone that maybe just doesn't understand or know the concept of neighborhood, what is the model? Why are brokers choosing you over other lenders? What clients are you serving?
It's so funny because we get this question from both the broker side and the investor side. It's like, who's borrowing from you guys these days, our rates are starting at about 6-7%. So the rates are pretty good. And on an interest-only loan, your payments are pretty good too. And what we say, our marketing line, and I always say it with kind of a smile because I both love it and think it's cheesy, but we lend to borrowers in transition. And whatever your transition event is, that's where a solution like Neighborhood fits. The prime space is, I haven't checked lately, but let's call it 500 billion in annual originations, right? It's huge. Our space might be 20 or 30, So I like to think that we're kind of eating the crumbs off the table. And so as the prime space gets tight, more crumbs kind of fall off. And so what are those crumbs? It's like, well, look, my bank, pick your color. I work with this color bank and I went to get a bridge loan because we bought our dream home. They won't give it to me. My ratios don't make sense. Well, send that deal to us. We can look at it. That's a transition. Another transition event we see is business for self clients, self-employed people. That makes up a huge chunk of our book. Like probably about 30% of our mortgages are to business for self-employed people who say, look, I've got this business, I only pay myself 100 grand a year, 150 grand a year, but my business does like 3 or 4.
Yeah.
Well, the bank is going to look at your T4 and say, you make 100 grand a year. 150 grand a year. You can't afford this loan. You go, well, no, I can. I mean, really, if I dividended myself or if I rejigged my structure here, I could. The bank says, well, come back when you've done that. So that's where we fit in. We're like, well, no, we get that. We understand that. So we'll lend to you. And what brokers love about us is we're very flexible. We're really upfront about our terms. You don't get surprised. We're easy to pay out. And it kind of goes back to that philosophy of we just want to earn our rate and get our principal back. So it's really simple. So for someone who's in that situation, the self-employed person is a really good example. Oftentimes they'll go back and work with their accountant and say, okay, I got to up my own personal payroll. I got to get my T4s in the right kind of place where a bank will give me a loan. In fact, we work with some banks on their deals, on their turndowns, so that they can cycle back into the bank, the borrowers can. The other examples would be things like, the dreaded Ds, death, disability, divorce. Those are transition events. They happen to everybody. And what we find is brokers can do well with us from two perspectives. One, you can earn two commissions. You get your commission when you come in with Neighbourhood, and then you get your commission when you map out the exit strategy. But two, you can do your client a really good service, despite the fact that you earn two commissions. If you were to put your client into, say, a B mortgage over 5 years, as opposed to working with Neighbourhood and then into a prime, if you map out how much interest your client's going to pay or what their time horizon looks like, chances are you will be better off going with us into a prime loan after 9 months as opposed to locking in at a higher rate over 5 years. So really thinking about your client's time horizon and sitting down with them and going, here's what we're going to do. Here's your plan. Here's how I'm adding value to you as my client. Don't go and walk into the branch. I'll make this work for you. So that's where we're finding our business. And so going back to the annual volumes, yeah, like the big prime space is the big one. I mean, that's the bread and butter. But in our space, you can make a pretty good business off of, $20 to $30 billion a year opportunity. It's out there. That's what we've done.
Are you seeing right now, like I know it as Deryk's point, like that shift into the alt side, is it kind of the same, let's call him more of a sophisticated broker that has been playing in that space that's just doing more business? Or are you starting to see a lot of newer brokers that are trying to reach out to you guys and really understand that market well? Like, is your growth coming from the brokers that have always been doing it? Or are you starting to see kind of a flux of brokers now trying to figure out this side of the market as well?
I think it's all of the above. I don't have the data at my fingertips. Our sales team would, but it's both. One thing we've really tried to focus on, and we haven't nailed it yet. We've launched it. I want Aeroplan for our broker partners, essentially. So we've built out, a relationship engine. We've got tiered and elite broker programs. So I really want to enhance that and to make sure that brokers who work with us think of us and are encouraged to do so. So that's almost like getting more of the wallet share of the types of brokers who do more of this kind of deal. To your point, that's one kind of category. There are brokers out there who are really good at alternative deals. They understand the space. They've got their favorite lenders. And if it's not us, give us a shot. But feel free to work with competition too. It's like this is a maturing institutional space. It's a good space to be in. It's very competitive. The other thing we see though, back in the day, we called it the long tail. Maybe we have a different term for it, but you think about all these brokers out there, even high volume brokers, they might have one or two alternative deals per year. So we also spend a lot of time kind of generally marketing to the broker community just so that they know when they have that deal on their desk, you can work with Neighbourhood and you can trust us. We will get your deal done. We'll handle your client well. And this is not a space to be afraid of. It's actually not that difficult. It works very similarly to the prime space. I call it almost like two buckets of brokers. And depending on where our energy is going, that's probably where we're going to see the growth. So that long tail is harder to market to, but huge volume, right? Like if every broker on our list just sends us one deal, our boots are full. But then there's the ones who specialize a bit more in this space and they're great to work with. They've got that pipeline. It's kind of funny in the AI world, if you can call our world the AI world today, we've been hiring more people. We actually just hired a CTO, Chief Technology Officer, who came on. Part of the Fisgard deal as well, we essentially doubled our tech team size. So we brought on like a really senior leader to help leverage that. But you hear about AI and it's like, you're hiring more tech people. Doesn't it all do it for you? It's like, no, it doesn't do it for you. You need like real leadership and engineering still. And then we've brought on more BDMs, so more boots on the ground. And we're just of the view that some of the old school things, you can have like the best kind of digital marketing, but it's really, really hard to beat showing up in someone's office, like literally shaking hands with somebody, breaking bread with somebody. That relationship building is still really important. So
We've been talking about this a ton lately, and more so from a broker to client perspective, but like everyone's so focused on AI and efficiency and making things quicker, which is totally fair. And I think everyone should explore and put resource into that. But like the human connection component of your business as a mortgage broker or a lender or BDM, like that's where you should be doubling down.
100%.
Because to your point, like, I don't know how many private lenders or MICs are in the country, but most of them send emails to a lot of brokers, in addition to the B and alt lenders, in addition to the prime lenders, in addition to appraisers and everyone else. Brokers get so many emails, it's hard to actually review and dig into them. But like if you're going to go for a lunch or a coffee or go golfing or come to an event, like that's where those connections are happening. And that's where brokers are going to recognize and remember. And like the consistency of seeing a Nilu as an example or a Jared at all of our events, like that stuff really starts to work. And that's what people need more than ever right now, especially on the consumer front, right? Like consumers, at the end of the day, if brokers go down a path where everything is tech, those clients will stop going to you and they'll start going to these online lenders because they don't have to deal with someone. They'll get a better rate, right? Because that's how those models operate.
So we bought a bike shop, and it's not just any old bike shop. It's one of Canada's leading online bike retailers called Beachy. And with that deal, we actually tucked in a couple more acquisitions on the island in Victoria. So there's now 3 locations of the bike shop. So Beachy does a huge amount of online volume across the country. But there was an interesting thing that happened when we bought the Victoria store. Online sales in Victoria went up 250%. And, there was no stopping us from sending stuff to Victoria, same ads, same people, all this. And our thesis on that is trust. It's like, well, now that there's a physical door that a buyer can go through and say, I bought this pair of shoes online, they don't fit. Can I, replace them here or whatever? That was just really an interesting one for me. It's like, you can be the best online, but you need a presence. And I think the key going forward is going to be figuring out the balance between the two. I forget what the number of brokers is in the country right now, but for us, there's no way we can meet 15,000 mortgage brokers. There's no way. We'll try, but we can't. But can we meet 1,000? For sure.
Yeah.
How do we get that balance? I just find that stat really interesting because we were shocked, like, wow, brick and mortar matters.
Yeah. Very interesting.
I think for everyone listening, I mean, the big thing is like we hear it all the time, is AI going to replace us, all that? Like just listening to that, take a breath. You're okay. Like focus on the relationships, and the AI is going to give us the ability to put further focus on that. And that's where I would put all my intention and energy right now. Your clients, your relationships, your partners, and just building that layer of trust with them. And I think that's going to be the long-term win for everyone.
We've built out a huge amount of automations, human-centered AI, human-centered automation on the underwriting side. And that's allowed us to be very quick, really great sort of decision-making logic and summary logic and all that. But I've been really clear with our underwriting team. We've not laid a single person off because of tech improvements. I said, this now gives you more time to review the deal holistically. Does it make sense? So rather than, renaming folders and copy pasting credit scores and that kind of stuff, which is totally error prone, you can call the broker. And so another thing we picked up, funny enough, is our top closing underwriter, and we don't pay our underwriters to close deals, just to be really clear, because I don't like that incentive alignment, but we have the data. And our best underwriter for closing, turns out his process is to call the broker. Basically be like, hey man, got your file, it's looking good. Like he has that touch point. So one thing we've changed in our process is we've told our underwriters, you got to call brokers more often and just be in the loop. Have we seen improvements? For sure. Like I couldn't even tell you, and I've actually asked the team to look into this. It's hard to measure, like how much faster are we today, thanks to our tech improvement, say compared to 2018 or 2017. We did have a tech team back then. We're way better, but that hasn't led us to have like a robot in the underwriting group.
Yeah.
It's still the same number of people and growing. Yeah.
That's interesting to hear about your underwriter that picks up the phone and like that's his process that he's created. And I always think about this from a client perspective and or a broker to lender perspective. But like as simple as that is and as little time as that would take, there's now a connection between me and underwriter Joe, whatever his name is. It makes it a little bit harder for you to go, man, that guy was awesome. He was super nice. Maybe I don't want to shop this for a slightly better rate.
Yeah, yeah.
Right. Whereas like if it's just an email behind a computer, like there's no relationship and I don't actually care that much that I'm going to move this deal somewhere else.
Yeah, 100%. It's so simple, right? If you're going to stake your claim in the labor force as I'm a really good copy paster, yeah, your job's probably going to be at risk for AI.
Yeah,
But
definitely.
if you can develop these other skills, and they're not hard, like calling someone, even if you're shy, is not a hard thing to do. I mean, they want to close your deal as much as you want to close it. So these are easy calls.
For sure.
Yeah.
Hey everyone, Dean here. Quick timeout from the episode to share with you the ABW Tuesday Mortgage Memo, your weekly market highlights sent directly to your inbox every Tuesday. This is certainly one you're not going to want to miss, so make sure to sign up now. You can do so with a link in the show notes, or you can head to joinabw.ca and sign up there. This is a high-level summary of market developments, regulatory updates, and housing trends every Tuesday. So hope you enjoy it, and back to the show.
The Fisgard piece, this is a big topic. I'm excited to learn more about it. In October of last year, you brought two very strong brands together when you acquired Fisgard Asset Management. Fisgard, I'm sure everyone or most people listening have heard of Fisgard. They've been around for over 30 years, one of the larger MICs in Canada at the time as well. Very established brand. So other than the Strandlands being such incredible people, like why Fisgard, why now, or why October of last year, and how did the deal come together, and how are things going now that you're, I guess, 9 or 10 months in?
Hand over heart, pull up a deck that we put together maybe in 21 or 22, where we had this M&A thesis in our space. And it's classic. You know, every private equity firm talks about there's a huge generational turnover coming. Businesses are needing exit strategies. Who's going to buy? And one thing we felt is that as our space got more institutionalized, as capital started to flood in, competition for deals would heat up, which has happened. Add in the slower mortgage volume piece, that's just made competition even harder. I think there's another side to it, though, where some of the, call it reverberations of this down market have yet to play out in our space, in particular in the residential space. But sticking to Fisgard, you know, we had this thesis and we've been kind of soft in the market. What's interesting is, of the groups we had talked to in the past, you kind of network, you hear these guys might be looking to exit. There was pretty big, call it valuation gaps. And there's a lot of people running small MICs who have inflated expectations as to what their MIC is worth. And at the end of the day, this is just pretty simple math. You're basically buying future cash flows. And maybe there's some strategic reasons to buy the MIC. And for Fisgard, we had some, which I'll get into in a sec here. But just sticking to the thesis, you know, we were out there in the market as people who, hey, we would be buyers. You know, I did a lot of M&A when I was at Stikeman. Alex has done a bunch of M&A through Lendesks and tuck-ins. You know, he exited that business to Rocket to the US. We know what we're doing. So we felt like we were a pretty good counterparty. You know, our age is an advantage. You know, I'm the oldest in our, call it, shareholder group or ownership group. I just turned 42. So we've got time on our side in some respects. So yeah, we were just out there in the market. And because of that, we got wind that maybe Fisgard would be for sale. And that was really interesting to us because going back to, you know, you mentioned the brand and the story and the Strandlands, like they're a group that we literally had on a whiteboard, or certainly in a bunch of spreadsheets that we kept, you know, in the 2015, 2016, like, hey, these guys are really good. In fact, Alex dug up an email that he had sent his dad, I think from 2008, saying, hey, Dad, check out Fisgard's website. I like what they're doing. You know, keep an eye on these guys. So yeah, they've been on our radar. They're a great brand. They had good but reasonable valuation expectations. You know, for something that big, it's a different story than like a $50 million or $100 million MIC. This is a real business.
How big was Fisgard?
About 300.
300. And you guys, so combined, you're around 800 now?
That's right. Yeah.
So you're one of the largest in the country.
We are now, yeah, thanks to M&A, right? So going into Fisgard, you know, it's kind of old school. Like we reached out, we had a call. There was a whole long song and dance. It's like dating. I haven't dated in 21 years, but sorry, I still date my wife. I think that's what you're supposed to say now. But you're out there trying to convince people that they should be with you. And the thing with Fisgard is we met, we said, hey guys, we think we'd be a good match. We actually approached them with a deck. Imagine going into a first date and saying, here's why you should date me. But that's kind of what we did with these guys. We said, this is why we would be a great match and why we can win the future together. And I think it was a compelling story. At one point, we went away. We just couldn't quite meet in the right spot. And we were good about that, but we kept the relationship going. I went and had breakfast with Rafer, face-to-face, talked, maybe we could have another date. Maybe it's worth talking again. If you change these things and I change these things, maybe we can do it. And then Alex met with him and had coffee. And it just kind of, it's like, this feels right. So we sharpened our pencils a bit. They sharpened theirs and we came together. And it was kind of old school in that regard. It's like, how about you trust us? Because they also care a lot about their family legacy and the brand.
Yeah.
And we're going to be stewards of that. And we are stewards of that. So the key for us with that acquisition, the reason why we were really excited about it, other than the brand and the team, I mentioned you're buying future cash flows. Yeah, that's important. But strategically, it was big for us. So it did a few things. And the thing I've been saying a lot is when people do M&A, they talk about synergies. You can almost do like a Monty Python type skit of sitting around a boardroom. Oh, synergies. Yeah, we're going to get synergies. But well, tell me what they are, write them down, model them, and let's see if they're actually going to work. And so we had a list of about 5 pretty strong synergies. And just to work through the first few, number one was the credit box. Like, man, if we can go to market with a bigger credit box, Neighborhood's got a ton of capital. We had better tech, better underwriting, better deal processing. So if we can offer the Fisgard credit box to our brokers who have been saying for years, guys, we need you to do more. You need higher LTVs. I'd send you my volume. We can win. So that was one synergistic plank. Another interesting one was on capital structure. So Fisgard has a retail operation. Over 30 plus years, they've brought on many thousands of retail investors. Neighborhood does not have a retail operation, really, to speak of. We had an exempt market dealer, but it was really in place so that we could bring on like friends and family in a compliant way. Our primary investor base is institutions and advisors. So we gained a retail investor base. And that was interesting because now you've got several thousand clients that you can market to, that you can do new things with. And then the list kind of went down from there. So it was a really compelling deal for us. We also felt that, it's nothing new in the industry. You guys have probably heard it too. A lot of people are like, oh, M&A is going to happen, M&A is going to happen, M&A is going to happen. Well, no one really did it. And we went out there and we're like, we're just going to do it. And I think now what's interesting is having proven that we can do it, we're seeing more interest in working with us. Because it's one thing I like to say, and it's not just me, ideas are cheap, execution is everything. So a lot of groups are like, oh yeah, we might buy a mix. Great. I encourage you to try it. It's really hard. It's actually really hard. And the buying, while it's hard, is kind of the easy part. The really hard part is integrating. And so it was a really weird time because before we had even closed the deal, we had started integrating. And not like in a formal way, because there's some reasons why you have to be careful with that. We're obviously not going to hand over a bunch of data. We're not going to compete unfairly in the market or anything. But you have to plan so that when you're closed, you now can be one unified business. And what does that look like? So we had months of meetings, mapping out technology, for example, vetting the technology. What are we going to use going forward? How is that going to work? How are we going to train people? What's the communication? All this kind of stuff. It was hard. Even building an org chart, like mashing 2 teams together, is its own challenge. So that part's been tough. So here we are, 9-10 months later, whatever it's been. I'd say it's been a success. Candidly, I'd tell you if it wasn't otherwise. There's definitely still a few wobbles. Back in March, it was still really hard. But here we are now, like the systems are humming, the teams are working well together. We've managed to integrate well. And one thing I heard from a person I really respect, the president of RBC BC, RBC bought HSBC. And he's like, oh, it took a year for the smiles to come back. Like M&A is hard. And I think we're a little bit ahead of schedule. I've seen a few smiles, definitely some frowns early on. Like change is hard for people, especially those who didn't know the deal was coming. I mean, I flew over to Victoria shortly before we closed to basically be like, I'm the new boss, And even for me, from a career perspective, that was an interesting thing to do, to stand in a room and be like, hi,
Yeah.
hope you're excited. Go for lunch and talk amongst your friends, and we'll reconvene in a bit here. It's been an interesting one. And, we're definitely out there in the market looking to do more if it's out there, but it has to make sense.
Well, it sounds like you guys have, put in the strides that you needed to leading up to the acquisition and the merger. And I mean, to your point, there's a lot of different kind of components of this business. I mean, it's the team, which is a massive piece. I mean, it's keeping investors happy, which is essentially a big component of what you've acquired. Hallie and Rafer, did they end up staying on in any capacity?
Yeah, they're shareholders and they're still on the team. They're not employees, but they're active. Rafer, he's a deal guy. So he loves, especially to the extent we do see the odd commercial deal come through. I mean, that's a muscle that Neighbourhood didn't have before. And Rafer loves looking at those, along with there's a dedicated underwriter on that as well. So that's fun for him. I think for a lot of people selling a business too, you have the conversation, what do you like doing? What do you not like doing? And every business leader has things they don't like doing. It goes, well, let us do that for you.
Yeah.
And you can enjoy doing the things you like doing. Hallie's network is crazy. If you look at the synergies, that was another thing we acquired. Neighborhood's really good at what I would call kind of the digital marketing, the hand-to-hand combat, less good at kind of the top of the house down relationship building. So Hallie has helped tons with that, like just introducing us to the right people and getting some relationships going there.
Now, correct me if I'm wrong here. It's still set up so there's two funds and Neighbourhood is managing, correct?
Yeah.
So what does that look and feel like for a broker submitting a deal? Is there any reference of Fisgard anymore? Is everything Neighbourhood now?
Everything's Neighbourhood. So the way we thought of it is this. We're going to have one broker-facing brand. It's Neighbourhood. And, there's a debate. Is it going to be Neighbourhood or is it going to be Fisgard? And our view is that Neighbourhood probably has a stronger brand in the market. We do more volume, we've done more digital marketing. Fisgard has more legacy.
Right.
But the reality is we're doing, 1.5 to 2x the volume of Fisgard. So let's make Neighbourhood the broker facing brand. So to the extent a broker submits a deal to us, maybe if you like really, really got in the weeds somewhere, and I'm not even sure then, they don't see which fund actually funds the deal. So everything you do is Neighbourhood facing. And that's worked really well for us. So internally, we have an allocation engine that decides where the deals will go based on risk appetite, based on leverage in either fund, capital availability, that kind of thing. So sometimes we don't even know where a deal is going to go when it gets submitted, but it doesn't matter to the broker. It's going to be the same underwriting, the same servicing. The pricing doesn't change, the last minute because it went to a different fund. It's all Neighbourhood. So that's good. But then we decided that Fisgard has a much stronger brand on the retail investor side. And so we've kept the exempt market dealer investment side of the business branded as Fisgard. And we've been leaning into that brand and we're doing more every day.
That makes sense.
We've got some exciting stuff in the background. Maybe that'll come soon. But like one interesting thing that happened was, we acquired Fisgard and thinking this is a little bit of, experience. Like, oh, these investors will be really excited. Big institutional investor. You're going to get better financing. You're going to get better reporting. You're going to get monthly distributions as opposed to quarterly. You've got a great management team behind it, all of it. A lot of them were excited, but a lot of them like, I don't know these guys.
Yeah.
And I trust the Strandlands. I trust Don. I trust the Fisgard team. Who are the, are they slick? Are they going to pull a fast one on us? And it's funny because that's not our business. We're very transparent. We like to fall in our sort of like, we do a thing we call the chart of the month for investor reporting. We're like, here's what's going on. You're hearing about redemptions in the industry. Here's what our liquidity looks like. Here's what we're doing. You're hearing about a lot of delinquencies. Here's a deep dive on our foreclosure files. Like, we're happy to share that with our investors. So for us, we thought these Fisgard investors will love it. I think it's taken more time than we expected to build that trust. And we knew it would just take time.
That's human nature, right? I mean, I think the fact that Hallie and Rafer are shareholders, that's telling as well. I think that's an important piece that, it's impressive that you guys were able to make that work as well.
When you talk about going through the M&A process, managing the org charts, the staff, all of that, and, your investors' expectations, how did you guys map out how you're going to kind of spread the word out to the broker community and what this was going to look like. So if you had a strong Fisgard user, like how that was going to look to them. Did you guys put a lot of thought into that whole process?
We did. And, you guys can be the judge as to whether we did a good job. But yeah, a lot of thought went into it. And it's nice to have a real deadline. So one thing we did in this deal is we wanted to announce the deal at the MPC conference in Ottawa in October. And trust me, that was really hard. I think at one point it was only Alex and I, maybe Rafer and Hallie, pushing back on the lawyers, the bankers, all of it. We're like, no, we have to close. Stikeman did the deal for us. I remember getting a call from the partner there who I used to work with, who actually helped hire. And he called me a few weeks before it was supposed to close. He's like, "Hey, Taylor." And I could just tell by the tone of his voice. And before he can even get into it, I'm like, "I'm not having this call. We're closing like in 2 weeks. It's just happening." He's like, "All right, that's why you hire Stikeman and all this stuff." But I'm like, "I know what this is. I used to do your job."
Yeah.
Like, it's not happening. We're just going to work till midnight every night for the next 2 weeks. This is going to happen. We're going to close, and I'm getting on a plane to Ottawa, and we're announcing this deal. So that's how we did it. We did have a strategy. We put a press release out. We definitely communicated with, a lot of broker partners. The key message and what I've learned with communication is you just have to repeat. It's like nothing's changing.
Yeah.
Really. Two great brands, but hey, if you submit through Lendesk, just keep doing that and we'll catch it. So your deal is going to be the same. So I used to bucket how the integration was going into sort of 3 buckets. And one of them was originations. And that is the one that went the best from integration. Like hands down went the best. Volumes went up right away. We got a big marketing bump from the deal. People were excited. So we saw submissions go up. The technology worked really well. The underwriting team from Fisgard adapted really quickly to the neighborhood underwriting guidelines. Like it just really worked. So that side, I think we did really well. Still got the odd question, but not so much anymore. I'd say after the first month, it was almost more technical. Like, hey, I'm going to submit my deal to Fisgard. What does that look like?
Yeah.
Our team was really clear on how to make sure brokers were comfortable with their submission and how it actually work and get funded. One thing I was really adamant on integration, I'm like, we cannot miss a funding. Like if someone's got keys waiting for them on a funding and we screw that up on Monday, it's a disaster. And so we spent a lot of time making sure that would not happen, and it did not happen.
From our shoes, and we talked to a ton of brokers, and a lot of them work with you. I heard zero negative feedback. So
yeah,
we would hear it if it was out there. Trust me.
Yeah.
I want to get some insights from yourself on kind of market trends, what you're seeing out there. Obviously, there's nothing overly positive in the market.
There's some.
Where we sit today, there's some positivities, but what are you seeing out there? What are you seeing in borrower behavior? And I also am curious to hear, what do you think the biggest risk and biggest opportunity in the market is today?
The biggest opportunity for us is growth. We still believe that there is some generational turnover. Like as more capital and more interest comes into the space, I think we're very well positioned to manage it because that's kind of always how we've operated. And we're not afraid. We've done some interesting experimentations with, multi-billion-dollar asset managers. And we've done correspondent lending, for example, where we'll set up a funding platform for another group. And some of these ideas haven't taken off, but we've done them. Our finance team is like first class, able to handle a lot of complexity out there in the market. This market is not getting easier. And rather than complain about it, we complain a little bit about it, but we view it as an opportunity. So a really great example is compliance. I'm just of the view that compliance can be a bit of a sword. So as we see more and more rules enter our space and more complexity, FinTrack coming in last year, perfect example of it. Groups like ours with 3 or 4 compliance people on the team are ready to handle it.
Yeah.
To give you a really great example, we hired a full-time AML person and built a process into our underwriting workflow where our underwriters aren't making the AML decision. So I think a lot of other groups, they'll get a file, there's a flag, now the underwriters slow down, they got to do an investigation, look into it, make a recommendation, all this kind of stuff. Our underwriters just go, okay, this is one that, for whatever screening reason needs a closer look. Let's send it up the chain, and I'm going to work on my next deal while our AML guy looks at it. And then he can come back and say, no, we got to decline, or we can absolutely go ahead with this. Here's my reason for it. So that's an advantage that if you're a smaller player, you just can't do that. You can't economically do that. So I think that's one thing that we see is we'll see more consolidation for that reason. It's Canada. I think our government and regulators like larger players that are easier to control.
Yeah.
Maybe that's getting a bit into my politics. I'm not saying that's a good or bad thing. I think it just is. Like OSFI, I'm sure, would love to get involved in this space, but it's going to be really, really burdensome for them to manage like 1,000 mix or more. But if there were 20, billion-dollar mix, maybe we see that environment shift a little bit again. So I think we'll be on the right side of that bet for Neighbourhood.
We're seeing the exact same thing in the brokerage space, right? Like a lot of these smaller brokerages, it just doesn't make sense anymore.
No.
If you go and hire that person, by the way, we were trying to hire your AML guy at the same time as you guys hired him.
Oh, nice. Yeah.
But yeah, we've invested a ton of money and resources into compliance to stay ahead of it because this is our path for the next, 30 years. And we want to make sure that we're above board and ahead of everything. And I can tell you for a matter of fact, because when we acquired A Better Way, the brokerage, I was the compliance guy and I'm not a compliance guy. And like you take that home with you, right? You take that to bed with you knowing that you're not doing enough.
Yeah.
If the financial resources aren't there to hire, that's how you live going forward. Like it's not a great model. So a lot of these brokerage owners are just opting out and they're going, I'm just going to go back to brokering. I know I can make a good living there. I don't want or need this stress. You guys are good at it. Take it and let's move forward.
The fun's getting sucked out, right? Like if you're running a $50 million MIC and you're a broker who kind of started this off the side of your desk and over 20 years, you've built up a nice little thing. I mean, 10, 15 years ago, that was a great little business to have, and you could chop off half decent dividend stream from that. But now almost all that's going to get eaten up by compliance. Like even for us, we used to say that sub 100 million, I don't know how you operate a MIC properly, that number's probably drifted up. Because if you just do the easy math, most MICs charge, between 1.5% and 2% on their assets to keep the math easy. Well, that's $1.5 to $2 million a year.
Yeah.
From that, you have to do, unless you're putting a bunch of costs on your investors, which we don't do, but from that, you have to pay marketing, you have to pay underwriters, you have to pay BDMs, you have to pay yourself, you have to pay compliance. Like it's not that deep of a capital pool. So whereas for a group like us, we can absorb and we'd be happy to take on that $1.5 to $2 million in revenue because we can do it at no added marginal cost.
Totally. Yeah.
I think that's what we're going to maybe see more of, or maybe these groups just fade. Maybe some of them just get stuck. Like I've talked to groups years ago who like, no, this is what we want to get paid. I said, your business isn't worth that, but no problem. I'm not going to argue with you over what your business is worth. There's no point in that. And we're kind of seeing some of them circle back. They're a little bit smaller. They've shed some assets. They're a bit more stressed. Like, oh, these things are hard. I got an email from FinTrack that I got to respond to. I actually haven't implemented my PPM, forgot about it or whatever.
Yeah.
It's tough.
So where is alternative and private lending heading, in your opinion? I mean, right now, it seems like a bit of a race to the bottom.
For price?
From pricing?
Yeah.
Now, you guys have always played in that competitive space, so this isn't new for you, right? It's new for a lot of the other players, but where do you see this going?
Yeah, I think it's going to continue. Like we've always had this thesis that this space will get institutionalized. It's part of the reason why we entered it in the first place. We talked about the family office story. One thing we were looking at was where do we think there are less competitive markets to compete in? Like through the family office, if we became equity managers, you're competing against like the smartest people on Wall Street who probably have an edge over you. They're in the right market. They're talking to CEOs. They've got faster data feeds, all the high frequency stuff. We're not going to win that game. We're smart enough to know we're not that smart. And so I think for us, we looked at this space like, wow, there's a lot of mix out there, but presumably not that sophisticated. I mean, when you kind of dip into there, because a lot of this information's public, you can look at offering memorandums. Like, we think we can compete better in this space. And I think we've been a leader there. I take credit for that. We've done a lot of things that a lot of our competition now does. Like we built what we felt was Canada's first leading syndicate of lenders. So we had a 5-bank syndicate. We're super proud of it. We pushed all the covenant terms as far as the banks would go, and no one else had our terms. A couple of years later, everyone else has the same terms because those bankers want to make sure they can go to their other clients and offer compelling things. We've always known that our advantages would disappear over time. You do a thing and the market's going to adapt.
Yeah.
But I think that's just where it's going to keep going. because at some point, that $100 million MIC is going to say, I can't lend at these rates. And the reason why I can't lend at these rates is I can't attract capital who will accept that return that these rates will generate. And I can't pay myself in the meantime. So absent some really wild financial engineering, I think we're pretty close to the bottom in terms of, let's call it spreads. Let's not call it rates, let's call it spreads, before we start to see, maybe investors like, I don't want to invest in a mortgage fund that returns 4%. I'll buy a GIC. Like, we don't compare ourselves to GICs by no stretch, but when people look at their alternatives, like, well, I liked a MIC when it was returning 6.5, 7.5, 8, depending on the rate environment. I don't like it when it's doing 4.5. It's not worth the liquidity risk. It's not worth the hassle, the diligence, all that. So I think there's a level, a lot of people go, oh, the Americans are going to come up. And I talked to a few of the bigger funds out of the US, and you have to think of it from their shoes. Why do they want to come into Canada to buy 5% paper when you can play in the high yield bond market, which is like infinite? You don't have to originate any deal volume and potentially collect a higher coupon out of that, right? Like, there's no reason for them to come up. In our space, when we're getting higher spreads, it's attractive, right? I could see why Americans would want to come up in like 2018 and go, gee, you guys are getting, like, for the risk you're taking, you're earning an extra 300 bips. That's compelling. I'd say that gap is closed, and probably permanently. The only reason why it wouldn't be closed permanently, I think, is if we start to see some of our competitors, see big redemptions, pull out of the market, all that kind of thing, then we will have more pricing power. Currently, we don't have a lot of pricing power.
So to flip that US comment around, is there a world where Canadian mix and alternative lenders enter the US market?
We've looked at it, like, maybe, but the US is a whole different place to compete. Like, the other thing that the US has, I don't know the market very well, but I think it has some advantages. You have one securities regulator as opposed to 13 would be, an easy one. I imagine it's the same for brokers, but I'm not sure. But the US has this whole, like, savings and thrift market where there's literally thousands of banks. They're set up, they're regional specific. I think that'd be really hard to compete against. Another thing I think I'm good at is I don't think I'm the leader who's got the genius idea and I'm going to, like, turn, 2x our growth in a year by going to the US or something. It's like, hey, how do we just get more of the current market?
Yeah.
And one thing that Jared Stanley in our business says, and I love it, he's like, our competitors are still in business. So if they're still in business, we can win more, right? Until we are the only player, there's business out there for us to get. So why would I look to go to the US right now with all the complexity involved in that? I mean, God forbid, even just the cross-border tax issues. So I don't think so. And I think it's the same coming up here. I think the financial incentive, it may be there. There have been some securitizations that have happened led by US banks, although Canadian banks have participated in our space. But even when we look at those, we go, well, like, when you do a securitization, all you need to consider really is your cost of capital. And the cost of capital of doing a securitization is actually quite high. And our math says that our cost of capital is about the same or lower. We're not afraid of that market. Plus, you're selling a huge chunk of your book. So you got to replenish your balance sheet after that sale. So anyway, worth watching. Who knows? OSFI can wave a wand and tighten things up, but they're actually loosening things right now because they want to see more lending activity in Canada. So we'll see.
So looking to wrap up here, just last piece, what advice would you give a broker that wants to do more in the alt and private space today?
Well, first of all, get more clients, because then you'll probably just see more alt deals. And I think going back to that human side of just business generally, maybe even life generally in this day and age, if you're just being a broker trying to compete on rate, maybe you're not going to win. But if you can compete on service and advice, you're probably going to win. And I think that's where we view ourselves as just an added tool in the toolbox. And a lot of brokers, I imagine, I don't know, but a lot of brokers who play in the prime space probably automatically think, my client's not going to hit the ratios for a prime loan, so I'm going to put them into a B. I'm going to call Equitable or Home and try to do a deal there. But think of us or think of alternatives, because you may find, and I just love this idea of sitting with your client and saying, I'm going to put you in Neighbourhood. Here's the rate. Here's your payment. Here's how you exit. It's going to be friction free. Here's what's going to cost you. And then, assuming today's rates in the prime space, once we qualify you and in 9 to 14 months or whatever it might be, you're going to get a a 3 handle on your prime loan. And over the next 5 years, you're going to come out ahead. And I imagine a lot of clients will be like, that sounds great. Like, thank you. When I walked into the bank branch, they're not offering me that. And so competing on that side, I think will earn a lot of loyalty and referrals and grow your business. And we almost view ourselves, we compete against other alternative lenders, but we also think that we can compete against the B lenders just in a different way, right? We will not compete as a permanent solution. Hey, you're not going to have a 40 or 30 or 35-year, because some of them have those 40-year amps. You're not going to sit with us and make your payments over several decades and pay off your home. That's not our deal.
Yeah.
But maybe if cash flow's tight, an interest-only loan is an interesting option for you, and definitely an interesting option as compared to locking into a higher rate. 100 bips more over 5 years is going to make you worse off as a borrower. So I think the brokers can do more service and just more education for their clients.
Go deeper on cost scenarios, right? And I mean, the penalty consideration in the exact scenario you just mentioned is a very real consideration. What does that exit look like? Are you timing it perfectly with your 1 or 2 year term with a true B or alt lender compared to, a neighborhood with an open product? So really good advice. That human connection too. I mean, it's important in every facet of life right now, but probably more so than anything in alternative and private. Like, these are the unique scenarios. Clients have no understanding. They've never heard of neighborhood. You can't do it through an online app to RBC or Scotia and get an auto approval. Like, it's just not that world. Clients need you as the broker to be their concierge, and go deep on the explanation as to why they're landing here and how they're getting out. And if you're not putting time into that in today's day and age, you probably are going to have a very short career in the sales world.
100%.
One thing I'd add to that is you guys have done just an exceptional job with hiring the right people. I think your sales staff that are on the ground from a broker-facing perspective, from their knowledge base for how they could actually educate the broker market in general on how to utilize neighborhood into their mortgage portfolio themselves. I think they've done an exceptional job. And I say this too many times on podcasts, but brokers, they misuse the BDMs. Like, these are your resource. These are the people that will coach you and guide you and teach you how to actually put this into your business. And you guys have some exceptional people that are definitely attached to a better way that, really have helped us move the needle and grow a lot of traction with you guys.
Jared Stanley is the second tallest guy in the industry.
I love to hear it. And I know our sales team will listen to this. They'll appreciate that. And they are great. Yeah, kind of going back to that philosophy, we're very diligent about hiring. We even do psychometric testing at the application stage. So that even screens out people who are just, resume bombing. Our people are everything, and it really matters. So I'm super happy to hear that. And yeah, we let them kind of do their own thing. Like, Nilu has her style, and Nilu has a different style than Thibaut, and they're both effective. And we're not like, here's the box you got to fit in and here's how you do your job. It's like, you're responsible for bringing in volume. So go get it.
She's the only BDM that's made our brokerage run up a mountain to build a relationship. So we'll take that.
It's a good thing I wasn't there.
You can't cycle up that mountain.
Yeah.
We'll wrap up here. Thank you very much, Taylor. This has been very insightful. We appreciate you taking the time to share your story with us and the industry. Thank you for everyone that's listened and made it right to the end. If you want to learn more about Neighbourhood, if you need a connection, reach out to us. We'll connect you directly. You can also find them online at neighborhood.com/brokers. We'll have Taylor's LinkedIn profile in the show notes. And yeah, really appreciate it. We're looking forward to seeing everyone on the next episode. And thank you again, Taylor.
Yeah, thanks, Taylor. Appreciate it.
Likewise, guys. Thanks for having me. It was fun.
Thank you for tuning in. If you found value in this show, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, and YouTube. Your support is incredibly appreciated. We also welcome your reviews and feedback, which are crucial in helping us deliver outstanding educational content. Feel free to share your thoughts. A 5-star review would be fantastic if you think we earned it. Now, a message about something that means a great deal to us and to everyone at A Better Way Mortgage Group. City Reach Care Society is our chosen charity partner for 2026. For over 20 years, City Reach has been serving thousands of vulnerable individuals, children, and families across Greater Vancouver. They call themselves the Hope Business. When you see what they do, you'll understand why. Through their Food for Families program, City Reach provides fresh, nutritious groceries to over 4,500 people every single month. They partner with 54 schools across Vancouver, Surrey, and the Tri-Cities to make sure kids have access to food, hygiene supplies, and the support they need to thrive. Every August, their back-to-school blast puts backpacks filled with school supplies into the hands of 1,000 children heading back to the classroom. Here's what makes your support go even further. Every single dollar donated to City Reach translates into $10 worth of food for families in need. You can learn more, donate, or sign up to volunteer at cityreach.org. That's CITYREACH.org. Once again, thank you for listening, and we'll see you on the next one.